Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Star Bulk Carrier stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Star Bulk is a shipping company focused on the transportation of dry bulk cargo. It owns 128 vessels with an aggregate capacity of 14.1 million deadweight tons. Their ships transport iron ore, minerals, grain, bauxite, fertilizer, and steel products. The company is headquartered in Marousi, Greece, and was founded in 2006. The ticker trades on the Nasdaq and Deutsche Börse. Let's get started with the model. This is a mid-cap company, 3.1 billion market cap. They're trading at $30 a share, and they have 103 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had negative free cash flow in 18 and 19, then 100 million in 2020, then they crushed in 2021 over 600 million. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's negative in 2019, but it's a big positive in 2021. Revenue is a sales for the company, and that is huge in 2021. Similar to all shipping companies, shipping rates have gone through the roof, and these companies are making money hand over fist. Their revenue is almost as much as 2019 and 2020 combined. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. The cost to maintain the ships, the cost of insurance, the cost of gasoline, that's all part of cost of revenue. Revenue minus cost of revenue gives you your gross profit, and their gross profit in 2021 was a lot more than 2018, 2019, and 2020 combined. Then below that is operating expenses. An example of this is payroll for support functions. Gross profit minus operating expenses gives you your operating income, and that was over 700 million in 2021. They received 315,000 of interest on their investments. They paid about 48 million of interest on their debt, which is a lot lower than 2019, a bit lower than 2020. They spent 8 million in financing costs because sometimes they finance vessels. Then other income and expenses. These are all the gains or losses not part of the company's core operations. If they sell an asset, the profit or loss on that asset will go into other income and expenses. Then you have your pre-tax income. They pay very little in taxes. Then you have earnings from equity interest. These are their earnings from investments in other companies. Earnings from equity interest does not get taxed. That's why it's below tax. And then you have your net income, which is huge in 2021. This is the income statement from the company's annual report. Their revenue in 2021 was 1.4 billion. About 60% of their revenue is from time charters, and about 40% is from voyage charters. Time charters are much better because it's a consistent revenue stream. Because someone may be chartering a ship for several months, where a voyage charter is just from one port to another. And once that trip is completed, then they have to find another person to charter the boat. Their biggest expense is voyage expenses, 226 million. I know they spend a lot in gasoline, especially that the prices have gone up. 208 million of operating expenses. An example of this is insurance. 31 million of dry docking expenses. These ships are huge, so to find a place to dock them between trips is expensive. 153 million of depreciation. The value of those ships sits on their balance sheet, and it's a pretty big number. And those dollar amounts are depreciated over time onto their income statement. 20 million of management fees, 40 million of G&A, and some other miscellaneous expenses. So they had a ton of operating income in 2021. They spent only 56 million of interest on their debt, so they had lots of net income. Their earnings per share was 6.73. Last year it was 10 cents, which is better than 2019 of negative 17 cents. They've been increasing their shares outstanding from 93 million to 96 million to 101 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. And they generated lots of cash flow in 2021 due to high shipping rates. They spent a lot in CapEx in 2018 and 2019. Most of their CapEx is the purchase of vessels. Operating cash flow minus CapEx gives you your free cash flow. And they had negative free cash flow in 2018 and 2019 due to all the spending and CapEx. But that turned out to be a smart investment because look how much money they're making now. They did add debt in 2018 and 2019, but they paid down debt in 2020 and 2021. In 2021, they paid down about $600 million of debt, issued $470 million. This is the operating section on the statement of cash flows. And the way you calculate operating cash flow, you start with your net income of $681 million. Then you add back the non-cash items on the income statement. The big one is depreciation of $153 million. Then you have a bunch of smaller ones. Then you have to adjust for changes in working capital. It looks like they extended $44 million of credit in 2021. That's a cash outflow. But when the customers pay for those receivables, it'll be a cash inflow in that accounting period. So their operating cash flow was about $100 million more than their net income. You want to make sure operating cash flow is higher than net income. If it's not higher, you just want to understand why. But for this company, their operating cash flow is higher in all 3 years than their net income. My two favorite numbers are revenue, that's the blue line, and operating cash flow, that's the orange line. These numbers are less susceptible to accounting tricks. And you can see their revenue looks really good. It looks like 2016 and 2017 were fairly similar. Then it jumped in 2018. Then it jumped again in 2019. It jumped a little in 2020. And then it shot to the moon in 2021, their highest ever. Same thing with their operating cash flow. That looks really good. In their investing section in 2021, they spent $130 million in acquiring and upgrading vessels. They received $9 million from hull and machinery insurance. That's a nice thing about having insurance. If something gets damaged during a voyage, you may get compensated for it. In their financing section, they received $470 million of debt. They paid down $600 million of debt. They paid out lots of dividends in 2021, $230 million. Last year it was only $5 million. So in their financing section, they had a cash outflow of $370 million. This is the equity section on their 12/31 balance sheet. They have $2.1 billion of equity. They raised $2.6 billion from selling their business, and they lost $550 million from running their business. Let's look at the capital structure. $2.1 billion of equity, $1.6 billion of debt. They're 57% equity, 43% debt. This blue line is their equity balance since 2015. And the red line is their debt balance. And the two numbers have been straddling each other for several years. But now their equity balance is much higher than their debt balance. This green line down here is their cash balance. I gave them the highest whack on Finbox, 10.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $2.9 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.9 billion. We divide that by 103 million shares. And we get a calculated stock price of $28.61. They're trading at $30.46, so they're trading at a 6% premium. It's a sell according to the model. It appears the forecast for shipping rates is going to decline. Their revenue projection in 2024 is $847 million. So that's how I got $847 million for their revenue in 2024. Their 2023 estimate is $1 billion. 2022 is $1.1 billion. And I just continued this pattern into 2025, so it's $676 million. In 2020 and 2021, they converted 35% of their revenue into free cash flow. So I multiplied their future revenue estimates by 35%. That's how I got their future free cash flows. The website Simply Wall Street values the company at $60. They're saying it's 50% undervalued. 6 analysts priced this stock, and the average price target is 37. The low is 30, the high is 46. This is where the stock has been trading the last 5 years. So you can see in 2021, with higher shipping rates, the stock has done really well. It was really low for a while. It looks like about $3, and now it's over $30. So a 10x since the bottom in mid-2020. In the past 5 years, the S&P 500 is up 87%, while this stock is up 224%. Here's a breakdown of their 128 vessels. They have 50 Panamax and Kamsarmax, 37 Ultramax and Supermax, and 41 Newcastlemax and Capesize. They have a pretty low beta, 0.87, so the stock moves less than the market. It's gone up 80% 8% in the past 52 weeks, while the S&P is up 6%. The 52-week low is 16, the high is 32. And the stock is trading above its 50-day and 200-day moving average. About 3 million shares are traded each day on this stock. Of the 102 million shares outstanding, 67 million are on float. 52% are held by institutions, and a little over 3% of the shares are shorted. I think just about everybody investing in this stock in the past 12 months is doing so for the dividend. It's just crazy high, 26%. And the way you calculate that, you take their last dividend payment, $2, times 4, since they pay quarterly, that's $8, and then take that number and divide by the stock price. If shipping rates stay this high, they'll continue to pay this massive dividend. But of course, if rates come down, then they'll pay a dividend like they did in prior years. And their dividend is 129% of their free cash flow, 121% of their net income. They either need to increase their cash flow or reduce their dividend, since in the long run you cannot pay over 100% dividend. Their dividend yield is projected to decrease, and by the end of 2024, the forecast is 8.5%, which is still a pretty good dividend. They've done 3 stock splits. In 2008, they did almost a 1-for-1 stock split. Shipping is a really volatile industry, and oftentimes their stock prices go way down below $1, so they have to do reverse stock splits so they don't get delisted. They did a 1-for-15 reverse stock split in 2012, a 1-for-5 in 2016. Their employee count has been pretty steady the past couple years. They're currently at 181 workers. If you put $10,000 into this company 10 years ago and reinvested the dividends, at one point you would have been down to below $1,000. You would have lost over 90% of your money. But since the stock price has come up so much in the past year, you'd be at $5,800 today. That's a 42% loss. But if you invested a year ago, you could have 10x'd your money. Half the companies held by institutions, 41% by the general public, 6% by insiders, and 3.5% by private companies. The biggest shareholder is Brookfield Asset Management at 25%. They own 26 million shares valued at $800 million. Then Fidelity, the CEO, owns 3.5%. Then an Italian shipping company owns 3.5% of the stock. Then another executive at the company owns 2%. Let's look at their financial ratios. Their 2021 was amazing, so they have really good price multiples, a PE below 5. That's stock price over earnings per share. Price to sales of 2.2 and a price to book of 1.5. And they have a really good price to free cash flow below 5. That's stock price over free cash flow per share. Let's look at their non-current assets. The value of their vessels is $3 billion. They have $1.6 million on long-term investments, $2 million on restricted cash. The assets they're leasing are worth $48 million and derivatives of $7 million. Let's look at their non-current liabilities. They owe $900 million on a note. They owe $400 million on a long-term lease. The reason they took on so much debt was to purchase vessels, and they owe $48 million on the lease payments on the assets we saw on their non-current asset section, and $1 million of other. They have a good return on invested capital of 18%. They can cover their interest payments 15 times. A really good ROE of 33%. That's net income over equity. They can cover their current liabilities with their current assets more than 2 times, and their quick ratio is 2.1. Let's look at their current assets. $450 million of cash, $21 million of restricted cash. They have $81 million of receivables. This is how much is owed to them by their vendors. $75 million of inventory. The inventory is made up of $13 million of lubricants. Lubricants help protect the engine and equipment, and it also makes the ship more efficient. And $63 million of bunkers. Bunkers are bins to hold the fuel for the ship. There's $9.4 million due to them. They have $29 million of prepaid expenses. A prepaid expense is when a business makes an advance payment for a product or service they're going to receive in the future. $2 million of derivatives and $15 million of other. Let's look at their current liabilities. They owe $157 million on debt. They owe $50 million on a short-term loan. They have $22 million of accounts payable. This is how much they owe their vendors. They owe $4 million to managers. In order for this company to conduct their operations, they sometimes hire third parties. That's what the managers are and the related parties are. That's 1.4 million. Accrued liabilities of 31 million. Accrued liabilities are expenses the company has incurred but hasn't paid it yet. 400,000 of audit fees, 122,000 of legal fees, 1.7 million of other professional fees, 25 million of vessel expenses, 4 million on swaps, and 60,000 on income taxes. And they have 25 million of deferred revenue. Deferred revenue is when you receive an upfront payment for a product or service that's going to be delivered in the future. So they received this 25 million of cash already, but they're not going to recognize this on the income statement until 2022. They generated 637 million of free cash flow in 2021. They have 392 million of working capital, and they paid out 822 million of dividend payments. So it looks like they have enough funding to get through the next 12 months. But they have to generate a lot of free cash flow in 2022, similar to what they did in 2021. The best way to look at ratios to compare them to companies in the same industry. There are 34 companies in the same industry as StarBulk, and if StarBulk has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They invested less in CapEx than the average company. They're less leveraged than the average company. They pay a ridiculously high dividend payment. They generate a good amount of free cash flow. They rank fourth in market cap out of all the companies. The average is 1 billion, they're 3.1 billion. Their price to book is a little worse than average, but their PE and price of free cash flow is a lot better than average. Price of sales is worse than average. They generate more revenue than the average company, and their 3-year annual revenue growth rate is amazing at 30%, double average. They have a high ROA, that's net income over assets. This shows us how well the company uses their assets to generate a profit. That's double average, and their ROE is also double average. So to summarize, I have them trading at a 6% premium, but so much is dependent on the shipping rates. If rates stay this high, this company will do well and pay a massive dividend like they did in 2021. But if rates come down, then you might not get a good dividend payment. It still seems like a good chance rates will stay high. There still seems to be a good amount of shipping bottlenecks. China recently closed one of their big ports due to COVID. So all these supply chain issues can only help this company. I rank their free cash flows 8 out of 10, their revenue 8 out of 10, and their ratio is 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.